Welcome to my YouTube channel, Accounting Basics Academy. This video is a continuation of a series that I have started on UK business tax basics. It will explain types of business structure and their tax implications. Business structure and tax implications. Choice of business structure. Business structure is how the business is set up. It can be an unincorporated business, such as a sole trader or a partnership, or an incorporated business, example, a company. When starting a business, an individual must decide whether to establish it as an unincorporated business or incorporated business. The choice has different practical, legal, and tax consequences. So here are some factors to consider. Considerations. You're looking at liability. For a sole trader or a partnership, the individual and the business are the same. The individual is personally obligated for all the liabilities of the business. When it is a company, the company is treated different from the owners of the business. The owners only own shares in the company. Another consideration is the accounts, regulations, and privacy. There are fewer, lesser rules to comply with when it comes to sole trader and partnerships, and there are no legal requirements to file accounts at Companies House when it comes to sole trade and partnership. But when it comes to company, it is subject to more rules, a lot of rules and regulations, including the Companies Act. There is a legal requirement to file accounts at the Companies House with companies. Other considerations: tax on profits. For a sole trader or partnership, adjusted trading profits are subject to income tax at non-savings rate of 20%, 40%, or 45%. There is also income tax, which depends on the level of taxable income. Personal allowance may be available. There will be Class 4 national insurance contribution due. This could be at 6% between 12,570 and 50,270, and when it is above this amount to 50,270, there will be 2% if above. This is in regards to sole trade and partnership. But when it comes to companies pay 19% or 25% on their adjusted trading profit. Companies suffer Class 1 employer national insurance contribution at 13.8% on earnings over 9,100. There is a 5,000 allowance available for companies to offset the first 5,000 paid on employer NIC, national insurance contribution due. So continue with tax payments. Another consideration: there are two under sole traders or partnership. There are two payments on account permitted. These two payments on account is on the 31st January following the end of the tax year and 31st July for sole trade and partnerships. For companies, for a small company, tax is due 9 months and 1 day after the end of the accounting period. So it's important that you consider these. Now, another consideration is extraction of profits. For a sole trader and partnership, extraction, meaning taking profit from the company. Extraction of profit is as drawings or owner's salary. Income tax is paid on taxable trade profits before any drawings or owner's salary is deducted. The above removes the tax effect, meaning there will be no tax implication if it is done this way. For company, the extraction of profit occurs through director's salary or dividend, or a combination of the two. There are different tax implications for either choice of extraction. We will do a little example. You do little example, you know. So extraction of, so when it is through salary for companies, when you are extracting profit through salary for individuals, meaning sole trader and partnership, there will be income tax after deduction of personal allowance. The income tax may be 20%, 40%, or 45%. I mentioned this earlier, dependent on other income by the individual. There will be class 1 national insurance contribution at 8% on any salary in excess of 12,570 up to 50,270 for 2024-2025 tax year. There will be 2% national insurance contribution on the excess if cash salary exceeds 50,270. For company, there is a class 1 national insurance contribution at 13.8% on any cash salary in excess of 9,100. There is an allowance of 5,000 deductible from the first employer's national insurance contribution due. The allowance is not available for companies with a single director and no other employee. Through salary extraction continuing for companies, the salary and the class 1 national insurance contribution are deductible from trading profits. This means that taxable trading profit is reduced, thereby saving corporation tax. This is when a company director extracts profit through salary. Okay. When it is through dividend, for individuals or sole trader or partnership, a partner in a partnership, income tax will be due on any dividend in excess of personal allowance at 8.75%, 33.75%, or 39.35%, depending on the individual's other income. There is no national insurance contributions for sole trader and partnerships. But for companies, if you're extracting profit through dividend, it is not tax deductible for the company, and there is no national insurance contributions. So we do a little example here. Here is an illustration: extraction of profit. Angel is the sole shareholder and director of Labrador Limited. The company has no other employees, so meaning this is a person who owns the company. She's a director, and there is no other employee. During the year ended 31st December 2025, Labrador Limited made tax-adjusted trading profits of 20,000 and had no other income or gains. Angel has other employment income of 18,000 and dividend income of 2,000, making her a basic rate taxpayer. Calculate the maximum dividend that Angel can take this year. So what I'm going to do to show you how she can extract this profit, the dividend she can, she is entitled to, the maximum dividend that she can take. So I will insert a blank document here, a blank document, so that I can do the calculation there. So I'm doing this calculation so you see. So this is Angel Labrador Limited. Labrador Limited. Labrador Limited. So extraction of profit. Of profit. Yeah. Through dividend. Dividend. Okay, via dividend. So here I'm just putting the pound sterling sign. So the adjusted trading profit. So Labradors. Am I correct here? Labradors TTP is 20,000. Okay. Now less corporation tax. The corporation tax will be at 19%. Less corporation tax at 19%. 19% of 20,000 will be 3,800. So we get the profit available for distribution. Profit available for distribution as dividend. Yeah, as dividend. So the difference between 20,000 and 3,800 will be 16,000, 16,200. Then income tax on dividend, meaning income tax on dividend, income tax on dividend will be 16,200, because she says a basic rate taxpayer, so will be 16,200 times 8.75. This is with consideration of other income. So it will be 8.75% of 16,200 will be 1,418. This is deducted. And then after tax, dividend kept. So dividend kept by after tax, I'll say after tax dividend for Angel will be the difference between 16,200 and 1,418, which is 14,782. So check the calculation yourself as well. So this is what she can extract from the business. So for more of this, subscribe to this channel. Also hit the notification bell for more of these videos. Join other students via this link, which I'm going to put, my Udemy channel, www.udemy.com/course/business tax UK-UK, and then referral code here. This gives you a comprehensive knowledge, whereby you're following the course, from lesson 1 until the end. This is just a basic foundational knowledge. Thank you for listening.